our COBT viewers and listeners. It's Maynard, Mike, and Todd here with something that we're super, super excited about. We've got Russell Hagen, who's the Senior Vice President and Chief Development Officer at Weyerhaeuser, joining us. Russell leads the company's real estate, energy, and natural resources effort. And within that, there is a division called Natural Climate Solutions. And so if you don't know Weyerhaeuser, you probably know the name from, going to the Home Depot and seeing the label on the wood. But Weyerhaeuser is the largest private owner of timber in North America. It's a huge manufacturer of wood products. But as you'll hear today, the company, as it relates to carbon sequestration, renewables, climate solutions, the company has a very large footprint in all of that and is doing lots of interesting things. So Russell, let me just pause and say thank you so much for joining us. We're super excited.
Well, it's a pleasure to be here, and I appreciate the opportunity.
Well, as we jump in here with Russell, Mike, what would you tell us about what's happening in the markets and what we ought to know before we go too crazy with Russell?
Yeah. Today's been a pretty good day for the markets. I think we're up a couple hundred points. But
Mike, get to the point. How's NVIDIA doing today? That's what everybody wants.
NVIDIA is up like 5 or 6%, but it's been down about 10% over the last week or so. From bond yield standpoint, bond yields are at 4.25%. They really haven't moved for 7 or 8 trading days. You're going to have a really important number on Friday. That's going to be the PCE deflator. The Fed's one of their most looked at inflation gauges. That's going to print on Friday, so expect a bunch of fireworks on Friday in the bond markets and equity markets. From the standpoint of crude oil is up about another $3 in the last week or so to around $81 a barrel. And I think, crude has been really stuck in a range for quite a bit of time. And it occurs to me, and I think most people realize that it's not a supply issue anymore. It's a demand issue. In order to get out of the 70 to 90 to barrel trading band it's been in for the last, say, 6-7 months, you're going to need demand to basically come through. We're going to have people have confidence, and they're just not there yet. So that's why energy equities are also stuck in sort of a trading band as well. I'd say from a natural gas standpoint this week, one of the things that was concerning to me is that gas prices have come down, even though weather is getting hot. The second thing that concerns me is that we had talked about, U.S. production had got down to sort of 97, 98 BCF at the real lows, down from 102, 103. We're back up to 101 to 102 BCF a day in gas production. And with the huge surplus that we have in natural gas storage, it's going the wrong way. And so that's kind of weighing on gas. So it's something to keep an eye on. I'd say from a broader market standpoint, like you said earlier, it's all about NVIDIA. It's all about tech stocks. Whichever way they go is which way the market goes. And last week or so, S&P and NASDAQ really went sideways for all intent, but energy outperformed. Energy was up around 4%. So it seems like when those sectors do poorly, fundamentals for oil and gas are okay. A little bit of money flow goes there. So they were up about 4% last week. Before we get to our guests today, we want to go ahead and, since it's really a kind of a timber show, we want to go ahead and give you some idea what's been going on in those markets. And if you look at the lumber futures year to date, they're down about 20%. If you look at the timber equities, Weyerhaeuser's down about 16% year to date. Rayonier's down about 10%. Potlatch Deltic's down about 18%. Interesting, S&P Materials is up 5% for the year. S&P timber REITs are down about 16%, and REITs in general are down about 4 or 5% year to date. One last thing we really want to talk about is, I know we're going to be talking about the carbon credit market with our guests as well, just to kind of show you what the EU credit market has done over the last, say, year to date, 1 year, 2 year, 3 year time frames. You remember in the EU credits were all the rage. Everyone was talking about it every day. What's happened? From a year to date performance, they're down about 15%. Over a 1 year time frame, it's down about 22%. 2 years down 20%, and 3 years up around 20%. And so right now, the EU credit market is around $68 per EU metric ton. It peaked at around $100 per metric ton, in I think March of last year. So, that market has kind of gone sideways. A lot of the, luster has come out of it, but, we're really looking forward to hearing what our guest has to say about the credit markets. So that should be interesting.
Well, I know it's, I'm tempted to jump ahead, Russell, because I know you guys have thought quite a lot about that and how you bring credibility to those markets. But Todd, before I get carried away, what's on your mind?
Well, this isn't the newest of news, but I've been thinking about it because I read an article yesterday. But as many of you know, the EPC and engineering firm Zachry declared bankruptcy in late May. It's been about a month. That firm was engaged by the Golden Pass LNG export terminal, which is an Exxon Qatari project. And after they declared bankruptcy, they laid off like 4,000 workers associated with that project. And I'm not really all that interested in sort of the contractual disputes between the parties, but just it kind of reminds you of the scale of these projects that we're building. The same article that I was reading yesterday mentioned that there are 20,000 workers employed right now in the 5 LNG export terminals that are under construction on the Gulf Coast. And so one of the things we'll talk about with Russell is, different kinds of renewable development. And it just got me thinking about how big all these projects are and the kind of inflation that we might need to think about factoring in to economics and cost pressure and things like that. The same article, quoted that year on year from the Bureau of Labor Statistics in Louisiana, oil and gas construction workers' wages have gone up 19%. And that's just in 1 year, 2023 versus 2022. So we talk a lot about all these projects that are getting built, whether it's Permian pipelines or power plants or carbon capture facilities on the Gulf Coast. But there are some pretty foundational inflationary items that we have to not lose sight of. Last thing I would say, when you think about this, you kind of think about how does it translate to commodity prices? And I just kind of went and looked back and wanted to know how things have moved. Natural gas is within 5 cents in Cal 27 and Cal 28 of where it was at the beginning of the year. Crude, on the other hand, has run up about $5 a barrel. So we'll talk more about projects and these kinds of things with Russell in a few minutes. But just the scale of 4,000 workers going home is really kind of stuck with me.
Yeah, no, it is stunning. And Russell, you got a feel for us around here. We're a bunch of energy, environment, all these kind of things. We're watching them at the big dose of the markets. Thank you so much for joining us. I didn't mention in your lead-in, you're not only the Chief Development Officer, and you're running real estate, energy, and natural resources, but you were the CFO. So you've seen this from many angles, and we're just delighted to have you and to learn a lot more about Weyerhaeuser today.
Yeah, I think you'll be timber experts by the end of this. I'm certain of it.
You have more confidence in us than we have ourselves, but thank you, Russell. Why don't we jump in? I mentioned in lead-in Weyerhaeuser, biggest private owner of timber in North America, just huge amounts of acreage. I think it's 10 million in the US and 14 million in Canada. Just vast activities and vast ownership of land and forests. But talk a little bit about the company, just because I don't think some of our viewers and listeners have a full sense of it.
Yeah, so Weyerhaeuser was formed back in 1900, so 124 years ago. And I won't go through the full history of the company, but it's kind of interesting. It was 900,000 acres were acquired in the Pacific Northwest by Frederick Weyerhaeuser. We celebrated our 50th year on the New York Stock Exchange just last year. We're structured as a timber REIT, which is a very tax-efficient way to own timber assets. You kind of mentioned we have 3 business segments. Really, our timberlands is what holds our 10.5 million acres. We have 2.5 million acres in the Pacific Northwest, just world-class growing timberlands. We have 7 million acres in the U.S. South, and then 1 million acres in New England. And then we do have 14 million acres under license in Canada. So U.S.-based acres are fee-owned. The Canadian acres are licensed. Basically, we grow, harvest, and replant trees. We plant about 110 million trees a year. We harvest 2% of our forests every year. 100% of our timberlands are reforested after harvest. It's all done on a sustainable basis. So the industry has the Sustainable Forestry Initiative. 100% of our timberlands are, held under that guidance under the SFI. We harvest our timber, sell it to wood products manufacturers like lumber, OSB, plywood, pulp, and paper. We have some export out of the West into the Japanese markets, but a majority of our harvest stays locally. You mentioned the real estate, energy, natural resources business. I'd say is with 10.5 million acres, you got a lot of option value. And so our goal is to capture the highest value from every acre. And we have a really strong track record of capturing, premiums to timber. We have deep expertise, a technology platform that allows us to do end-to-end portfolio management. And then we have our emerging natural climate solutions business, which I'm sure we're going to dive into a little deeper. I think the last piece is we're one of the North America's largest low-cost wood products producers. We have 35 mills. We produce lumber, oriented strand board, engineered wood products for both residential construction, commercial construction. Really a strong brand, strong reputation, really a great manufacturing system.
No, it's really, as I say, we've been just enjoying getting to know you guys better, getting to know the company better. What's funny, Russell, is in the pregame, some of our teams been saying, well, wait a minute, this is a resource company, but the resource is growing.
Right.
We're used to mines and oil and gas where you got to go find more. So it's really something.
Yeah, it's a unique resource. There's no doubt about it. And I think as you look at, the asset class, particularly given, it's in a very tax efficient structure, we have a biological growth every year. And so it's not like gold or mining, et cetera, where you're depleting over time. We manage it on a sustainable basis to ensure that our forests are available not only for the next generation, but for many, many generations. And so we have a very, very long-term view on how we position the portfolio and how we manage the portfolio. I mean, we think in terms of, it takes 25 years essentially to grow a tree in the South to full maturity and kind of capture the full cash flow value of that tree. It takes 45 years in the West. So we have a very long-term view of the portfolio and kind of how we position the business.
Well, I think we started talking because we noticed your natural climate solutions initiative. And I think we probably I'll speak for our team, we probably all jumped right to the conclusion like, oh, it's forests, it's carbon capture, with nature, which we're big fans of here. We're very interested. But then as we dug in, there's a lot more going on than that. You have land that renewables utilizes. You have sequestration going on. And yes, you are thinking about the credit business, but there's just a lot more to your that division than one might think. Do you mind just talking about when you say natural climate solutions, like what are all the various aspects of that division for you guys?
Yeah, so kind of in the role I'm in, we have a real estate program, and that's really identifying a relatively small subset of our timberlands that are going to have a higher value, really a much higher premium to timber operations. And so we'll sell less than 1%, through our real estate program on a regular basis. Then we have real estate development. That's a relatively small subset of those acres. Also, those are very targeted acres. We tend to do just horizontal type development. So we don't do vertical development on the real estate development. We partner for that. And then we have our energy and natural resources. That's legacy oil and gas, primarily natural gas. So, I think when Todd mentioned natural gas prices, we're very aware of that. They haven't been very stellar of late. And then we have a mining and minerals operations. And these are basically leases that we enter into to third parties to come and develop those resources. On the natural climate solutions, you're right. We have a myriad of opportunities on our portfolio. We have conservation and mitigation banking, solar and wind, carbon capture, sequestration and storage, and then carbon forestry. Those are kind of the primary businesses that we've been focusing on as we develop our emerging natural climate solutions business.
Well, and then I think what's striking is you guys are talking pretty ambitiously in public about the natural climate solutions. Like the EBITDA from the business is over $40 million, and you're talking about growing it to $100 million by 2025. So that's a very sizable, climate focused business.
It is. It's kind of interesting. It's like starting a startup within a large company. And because a lot of what we are doing is attracting developers, for instance, for the development of carbon capture and sequestration, solar, wind, et cetera. It takes time. It takes time to, negotiate the contracts, get the developers in place. And we've had a lot of success over the last couple of years. We launched this business in 2021. We have 3 CCS agreements in place. We have about 100,000 acres under lease under our solar development program, a number of wind development sites, I think we're the 3rd largest mitigation banking group out there. And so we're still seeing, this development focus, and we're seeing good traction, but it takes a little bit of time. So we have seen good growth over the last couple of years, and we definitely see kind of our way to a $100 million milestone. And I'd call it a milestone because I think as I look at demand, just the broader demand in the marketplace for nature-based solutions, particularly forestry carbon capture and storage, bioenergy, carbon capture and sequestration, I think this business has the potential to grow well beyond the 100 million target that we set out as kind of our initial position.
Well, and Mike referenced this. I think for people around the carbon credit market, you know that there's a big sort of unregulated market. I think the other thing that we all know, and you guys talk about it, is that to do everything that we're proposing to do, we're going to have to utilize more of the credit market. The White House recently put out some new guidelines on trying to improve that market, and then I'll let you explain it. But part of what I think Mike was referencing is that unregulated market has sometimes taken a few reputational hits because, it's kind of a Wild West kind of thing. And you guys have been pretty patient around, well, wait a minute, we're gonna really think this through before we start leaning into it. But let me let you address that, because I think we're all very interested in carbon credits and more nature-based solutions.
Yeah, and I think you're right. The voluntary carbon market, I think the reference to the EU market, that's a compliance market. In California, the California compliance market, we're actually focused on the voluntary carbon market. When we launched the business in 2021, we spent quite a bit of time. We really did a deep dive in how projects were being developed, how they were being managed. We looked a lot at the REDD+. This is reduced emissions from deforestation, forest degradation. This is primarily the projects coming out of the developing countries. And this is where I think a lot of their critique has really been focused as far as the risk of overcrediting and some of the value of some of those projects. Our approach, typically in the United States, is an improved forest management approach, so a little different than the REDD+ approach. But we went through and looked at, how is the market forming? What is the critique in the market? How are the developers operating? What are the economics? What's the risk-reward analysis? Pretty typical kind of round-up business review and strategy. And really concluded that given our portfolio, and again, we have a unique portfolio with 10.5 million acres, that we wanted to make sure that we controlled the development so that we don't put ourselves in any reputational risk compared to kind of the critiques that we're seeing in the marketplace. So we wanted to make sure that any project that we brought to the market really had the highest integrity and the highest quality. So it took us a little time. We had to build the team, make big investments in the team so that we could essentially develop the skills and the capability to do our own development and not outsource that development. And what we found is, when we took our first project, the main project to the market last year, buyers were really looking for this. They wanted somebody to stand behind these carbon projects because they have to put this on their balance sheet. I remember sitting in the CFO chair. You're going to put something, if you're going to make a capital allocation, put something on the balance sheet, it's subject to, internal review, external review. So we found that we had a very, very favorable response as far as the buyer's view as to how we approach this project. And early in our development, Maynard, we set up what we call our carbon principles. And so we were able to point to those principles and point to our project and demonstrate that what we were doing represented real and measurable change. So we are truly changing the way we manage these forests to capture that additional carbon, that carbon would be held within the project over the life of the project. So it was, a real benefit. And then we are very transparent. And so anybody can look and see, how we're doing our project. We're following clear scientific methodologies, and then it's all verified by a third party. So, we've definitely taken the time to build this program so that we can stand up to the scrutiny, because we know there's just a tremendous amount of scrutiny in the marketplace. And I think the last point, this is kind of just the economics of the business. By doing our own development, it really provides us with the highest return, because we can control, candidly, who the counterparty is, how we're transacting. We don't share the economics with the developer. The developer, they take a pretty big share of the economics, and the fact that we will be replicating or doing multiple projects over our portfolio, which is pretty unique. It definitely makes that investment in the development part of this make a lot of sense.
I'm wondering, Russell, just if let's say I'm out here and I would like to buy some credits to mitigate my activities. Do you mind just walking us through at a very basic level? Let's say I'm a petrochemical plant, and I call you and I say, okay, here's my emissions, and I really want to offset them. Do you mind just kind of walking through the mechanics of kind of how it's going to work and how you're going to interact with them, and just what it's like to place that order, so to speak? Because I think we have a lot of people watching this who would like to understand kind of how that really works.
Yeah, and that's a great question. The other piece we did when we launched the business is we did a lot of work identifying kind of who those counterparties would be and understanding what their requirements were. And as you could imagine, a lot of the companies that are coming into the market to acquire these credits are doing a lot of their own due diligence because they recognize their reputational risk if they don't do these transactions correctly, if they don't have a strong counterparty. And so what we did is, instead of doing the actual marketing ourselves, we brought in a partner called Carbon Direct, and they do the marketing on our behalf. Plus, they have a really fantastic science team that looks over our shoulder, and it lends additional credibility to our overall project structure and plan. And so we rely on them. We work very closely with them. But essentially, what you would do is, if we brought credits out, and we brought 32,000 credits out last year, and we'll have about 100,000 credits out available by the end of this year, and then it will continue to grow as we build additional projects. We would, interact with you on the one transaction we completed. We did a detailed due diligence review. They looked through our whole project. They evaluated it. They had their team partnered with the Carbon Direct team and our team, really making sure that they knew exactly what they were acquiring. And so until the market really gets to the point where we have higher degrees of standardization from a contracting standpoint, and we really see velocity in the market, and the trust issue that you raised earlier is kind of established in the marketplace, and we get differentiation between high quality projects and lower quality projects, which I think we're doing. You can see that in how some projects are pricing. Until we really get a market where we have significant velocity, it's going to be more of a over the counter kind of a traded or contracted base. So you would basically sit down with us and our partner Carbon Direct, and we would figure out, kind of negotiate a contract for the purchase of those carbon credits.
So this is the voluntary market, and these credits are different based on the projects, and some projects are just not as authentic or as genuine as other projects, and they're not as certified. So you've got this voluntary market with it's not a commoditized product at this point.
Correct.
Just what is the rough pricing in today's world? Do you mind just big picture, just talk about where these types of credits will be selling? Because they are very different.
Yeah, I think the last I saw it, probably some of the red credits are some of the ones that I would consider, that the market would view as lower quality, might be trading in a $5 range. I think, the one thing I will differentiate is just It's a little different. There's what we call removal credits and then reduction credits. And removal credits are actually credits that are related to additional carbon that's being captured like within the forest on the trees. So you change the way you're growing that forest so that you either defer harvest or you change silvicultural practices. But you can demonstrate that that tree, you have grown additional carbon, another ton of carbon, and it's sitting on the stump. And you're going to point to that and you're going to hold that additional ton of carbon over the life of the contract, which is typically 40 years. Whereas a reduction credit is you're basically saying, hey, I didn't cut that tree, therefore I didn't release that carbon. And so there's a price differential between a removal credit and a reduction credit. So for instance, I can point to, the credits that we sold at the end of last year. It was $29 a credit. We were very pleased. That was a very, high quality project, and we got a very strong price. I think in the marketplace today, you would probably see those were removal credits. A reduction credit might trade around, $10 to $15. So kind of the red plus, those tend to be reduction credits. In the emerging kind of markets, specifically trade around $5. I'd say a reduction credit, maybe 10 to 15. And then I'll just point to what we got for our removal credits at a $29. So right around $30. That kind of gives you a base on what the voluntary market is looking like today.
Well, it's so striking because we're around, people talk about, potentially what would a carbon tax, where would it come in? Or people talk about various technologies and how much they're spending to capture a ton of CO2. And this is why nature-based is so attractive, because even these premium credits are so much cheaper than some of the things we're talking about. But Mike, let me get you to jump in here.
Yeah, Russell, I noticed that in one of your presentations, you guys have got about $1 billion in M&A goals by 2025, I believe. And I think you're halfway there right now. I guess my question is as your business is changing, your natural climate solution businesses and carbon credits and all this other stuff, when you look at M&A, how much that purchase price is just the timber, and what kind of percentage returns are you looking on that business, and how much can you tack on the back of it with these new businesses? I mean, how much of the purchase price is the other stuff that we can potentially do in the next couple of years?
Yeah, great question. One of the other areas that I'm responsible for is our acquisitions and divestitures group. And so what I'd say is, we set out $1 billion target. We've been making great progress in acquiring high quality timberlands that have really improved the overall performance of the portfolio. As we think about the underwriting and kind of the return profile, from an underwriting standpoint, I'd say the market has definitely started recognizing the value of nature-based solutions or natural climate solutions. We've seen what we call alternative capital coming into the marketplace, primarily from Europe, a little bit from Asia, looking for, carbon type or ESG type investments, and they're pointing that capital towards timber. And so we definitely are seeing, some new entrants into this timber space that, candidly, are bidding up value. We can really see some, fully reconcile the value that some of these transactions are going for just on timber return profile. So the assumption is that value is starting to be bid in. I think that's a pretty, small subset of the total market, but it's putting a little bit of pressure on timber values. As we think about the return in our underwriting, we definitely focus on the timber, kind of the timber return values. One of the benefits that we have in our A&D program is because of our large portfolio, whenever we go out and complete a transaction, we can capture a lot of synergies with our existing timber operations, then also synergies with our wood products operations. So we definitely get a benefit kind of in that frame. But if you just look at timber returns, kind of cash on cash type timber returns, and you can point to NACREIF, which is kind of an index that we look at for broader timber returns, it's kind of in a 4 to 5% cash on cash return. We look at our total return profile more like in a 7 to 9%. And part of that is we know we're going to capture the benefit of our silvicultural programs. We know we'll capture the benefit of some of our alternative value programs. We don't fully underwrite those in our acquisition, underwriting, but we definitely look to have those add to the return profile over time. And then we're going to capture additional value from synergies. This really doesn't contemplate capital appreciation. And we have seen capital appreciation really over the last 10 to 15 years in the timber markets.
When you think about the market right now, I think your CEO was at a recent investor meeting or some sort of conference and talked about the lumber market, just the residential market, the building markets as, and I kind of found it a little bit interesting that he said it's really been underserved, it's underbuilt quite significantly, and obviously interest rates has gone up. We remember 2 years ago we saw prices go from 400 to 1600, right? And now we're kind of back down there. How do you guys think about the market right now? What does it look like? What does the channels look like and stuff of that nature?
Well, you opened up your comments talking about, lumber down 20%, equities down 16, 18%. I think right now what we're seeing is it's a little interesting. We're definitely underbuilt in the residential housing. We got a demographic wave that is looking to enter the market. I think some of that lack of inventory has kept prices elevated, even in a high interest rate environment. And then the other element we have is kind of this, what they call a lock-in effect, where you're not seeing, traditionally you would see, move up type activity. People don't want to give up a 3% mortgage rate and go embrace a 7% mortgage rate. And so we're just seeing the market, all the inefficiencies kind of resident within the market today, even though we have these very strong demand indicators. We're 4.5 million units underbuilt in the United States. We really haven't recovered back from the great recession, that 2006 through 2008 period. And so we're very underbuilt. Average house stock is over 40 years. That really bodes well for the repair and remodel market, but we still need to produce, more homes. So I think the overall demand signals or the demand, profile is very strong. We just have to kind of get interest rates, get the buyers calibrated so that they can enter the market with confidence, and candidly get the entry point on pricing to be such that they can enter the market. Some of that really is around, permitting, entitlement, et cetera, the kind of the basics. And then, as you mentioned earlier, inflation has not helped in the cost of building a home today. Labor rates are up and lumber prices are down. There are other commodities that are still pretty elevated. So it's become a bit of an expensive proposition, and affordability is an issue that I think needs to be addressed to really unlock the market.
Hey, Russell, I'll kind of pile on a little bit to Mike and a little bit to Maynard, but I was thinking about risk management, and you have this traditional business that's tied to a pretty long-standing commodity in lumber, timber, however you want to characterize it. You've got this new business where you've got these voluntary carbon credits you're selling. There's different vintages of those. You've got to make investments around those. Talk about how you think about hedging and whether you can hedge, and maybe how it looks different in the traditional business versus the new business. I mean, there's a lot of components here to both sort of a production volume, but also a price that you're going to receive for all these activities you're undertaking.
Yeah, I think in general, when I think of, we typically don't use, hedging products, et cetera, in our commodities business, like in lumber, et cetera, businesses. Those markets, the derivative markets, are pretty thinly traded, and it's just not a strategy that we had embraced. I think when I look to the natural climate solutions, the one character of that business is, we're entering into contracts that are over a long period of time. As I mentioned earlier, we're very used to 30-year time horizons, given the way we manage our assets and manage our forests. But, you enter into a solar agreement, it's 30-year agreement, wind agreement, same thing. Even a CCS agreement, a carbon capture sequestration agreement, is the same. And so what we've typically done is structured our contracts so that we're not locking in price, that we get the benefit of any future price appreciation. That's kind of the key element of the contract, and that protects us from being locked in over a long period of time in an unfavorable pricing environment. On the forestry carbon side, we're really just starting to build that portfolio, kind of that pipeline of projects. And so we really haven't had enough volume to where we might forward sell kind of on a price basis. And I think today, when I look at the demand that is forming around the voluntary carbon market and forest carbon in particular, I just don't think there's enough supply to satisfy the demand. And I think as the supply, there's more credibility in relation to the supply, that demand is going to be very strong. And so we're reticent to really lock in any pricing, any forward pricing, or candidly forward volume until we see that market mature. And we do have the vehicles where we can do that efficiently.
It's super interesting, and I know it's developing, and it's hard to manage through all that. That's kind of why I was curious. The other kind of risk management oriented question I had, I think you mentioned earlier that you guys develop something like 2% of your acreage every year.
Right.
You harvest 2% of your acreage.
Correct.
Excuse me. How did you come up with where did that come from? You know, you've mentioned 25 years for some of the southern acreage, 45 years for the western acreage, but it seems like that's a pretty interesting number to mess around with, in both in terms of your yields on any one given year, but then in terms of these longer dated projects that you might want to think about monetizing. How did that number develop?
Yeah, it's actually pretty simple. It's we're committed to managing our forests on a sustainable basis, and so we're not going to harvest more than we grow. And so, as I think I mentioned earlier, we plant over 110 million trees a year in our timberlands, and that's after we harvest. And so, really, that math, the 2% kind of average is just that is what the rate of harvest supports for a sustainable forest over a long period of time. You may get some fluctuations depending on the mix of harvest or where you're harvesting, but on average, we'll harvest around 2% a year.
I was thinking, Russell, it's very interesting that your background is you were the CFO of the company and you're now in this role. And one reason I say that is a lot of times around here, we'll be looking at some sort of new technology or some approach or something that's going to make the world a better place. And we always ask ourselves, well, this is cool, but would it pass the CFO's test? And the CFO's test is really okay, I understand we're going to spend money on this. Are we getting the value that we want to get? And does this make sense? And is this sustainable? And what's the premium we're paying for a couple of things that we're trying to do that are not necessarily just cash on cash? What has you being a CFO, what has that brought to your role here as the Chief Development Officer? Like, how does that affect your dealings with other company or how you're driving other companies or how you're driving the division? It's unique that you were the CFO and you're now in this role.
Yeah, Maynard, I think a couple of things. The first is really an appreciation. When you're sitting in that CFO chair, your job is to allocate capital. I mean, that's a key component of your job is to do an excellent job at allocating capital. That means, dividend policy, share repurchase, capital investment, that's the key factor. And so as we've seen this demand, particularly a lot of companies coming forward with net zero targets, a lot of companies, making commitments. It really was in the back of my mind. I was kind of curious if people really understood what kind of financial and capital commitment that means, particularly as they have to invest in, carbon reduction strategies, retooling some of their manufacturing base, et cetera, just to reduce the carbon. The net zero is, hey, I've done everything I can to reduce my carbon footprint, and now I'm going to go buy offsets to kind of clean up that remaining, what I call hard to abate carbon. That's what net zero really indicates. And so from a financial standpoint, sitting in a CFO chair, you're going to be pretty thoughtful about, am I going to invest in a carbon reduction reconfiguration of a manufacturing facility? Or do I invest in improvement in reliability, improvement in production, et cetera? Those are very different economic outcomes and economic analysis. And so appreciating that, and then put on top of that, now you're going to invest in offsets. I think from my perspective, I wanted to make sure that anything Weyerhaeuser brought to the table, again, had the highest quality. So as CFOs, capital allocators are making those decisions, they have a clear view as to how we're approaching this, and they can have confidence as they make those investments and candidly put those assets on their balance sheet. But it's going to be, I think, as we see more and more demand from government agencies, regulators, stakeholders, shareholders, et cetera, to embrace these carbon reduction strategies, this capital allocation is going to be really in the front of a lot of CFOs' minds. How do I make those trade-offs?
Did it also resonate that, as the CFO, you're always worried about the disclosures, the audits, the accountability, this type of thing? I assume that informed, as you thought about your customers, when that CFO is saying, somebody is going to come and ask me for the backup data on our carbon footprint, on our credits. I assume that was a big piece of your thinking here.
Yeah, absolutely. As far as, when we formed it, I definitely had a lot of the CFO, requirements fresh in my mind because I stepped right out of that role into this role. I actually did both roles kind of on a staggered basis. And so making sure that, again, whatever we brought forward was of the highest quality and the highest integrity was absolutely critical, because my counterparty or whomever I'm contracting with is going to have to, again, put the asset on their balance sheet, and it has to hold up to audit, and it has to hold up to scrutiny. And neither Weyerhaeuser nor the buyer of these credits or these nature-based solutions are going to put themselves at risk from a reputational standpoint.
So maybe one question, Russell. Now you're, I assume, sort of running in the nature-based solutions community and going visiting those conferences, those gatherings, other people who try to either provide these credits, buy these credits, middlemen, that whole investors. What would you tell us about that community? Like, what's your experience getting to know that world out there?
I was we had a team over in Dubai for COP28, and I heard an interesting quote. It was like 2 or 3 COPs ago, it was all scientists and policymakers, and COP28 was definitely, business centric. So their comment was, finally we're seeing this market mature. And so the capital is definitely coming to the table and is starting to appreciate that they need to find solutions. And so as I see that market continue to develop, I would say there's a lot of emerging markets, everything from CCS to direct air capture to bioenergy carbon capture, all the, fiber to fuels, SAF, et cetera. There's so much innovation in the marketplace, but there's also a tremendous amount of capital now being pointed to the marketplace. I'll point to, the IRA, the Inflation Reduction Act with the 45Q, that change in the 45Q to where CCS went from $50 to $85 a ton, DAC went to, I think, $185 a ton. We had the Infrastructure Act, we have clean tech that's being built out. I mean, this is attracting a lot of investment capital, and it's attracting a lot of attention. And so we're seeing this market definitely be catalyzed by a lot of this investment and favorable policy. And so a lot of the people that are in these conversations are much more business centric. And I do think they're having an influence on policy. For instance, you mentioned the White House came out with favorable statements on voluntary carbon markets. I think that was a big move. The Science-Based Target Initiative has pointed to, looking to voluntary carbon markets also. That's a very significant positive move. I think a lot of that is centered around just the appreciation, the economics of this have to be taken into consideration.
And when you think about this business, the natural climate solutions business, and I don't mean to, we could be talking about solar and CCS and, the kind of the rest of your business, but I think this one is probably the most unique, the natural climate solutions. Could you see growing that dramatically? Because you mentioned that, you're doing all of it yourself and you're really controlling it, but you could manage those operations for other people. You could go international with that. Like this business, once you figure it out, and it does seem like the world is realizing this has to be a huge part of the solution, it seems like this could be a dramatic growth vehicle for the company over the next 10 or 20 years.
Yeah, Maynard, I think you're referring more specifically to forest carbon, I'm
Yes,
assuming.
sir.
I would say, we're really pleased with the way it has developed, but, one kind of governing, kind of aspect of this is, we have 10.5 million acres, but you're not going to do forestry carbon on 10.5 million acres. So we have to identify those timber, those wood baskets, we call them, or forest, where it makes sense, where we can actually continue to manage the timber for a harvest outcome, kind of for our core timber operations, but change it just enough so that we can capture additional carbon, for a carbon project. So the real goal is to find where in that 10.5 million acres we can do both. We can manage for two outcomes. And so that limits to a little degree, how many acres we'd actually put into a forest carbon program. But we definitely have, multiple sites. We have the opportunity to build out a robust pipeline of projects over the next number of years. One, element of this, though, is it really depends on what is the value of a future, forestry carbon credit. If the carbon credit values increase significantly, that changes our economic analysis relative to what's the value of a harvested timber versus the value of timber being held for a carbon outcome. We're not at that point yet, but I think our analysis is constantly going to change as to what is the right trade-off for the value for the portfolio. As far as going outside of our footprint, we have thought about that. I think we've built an exceptional team. We have excellent technology platform where, we use remote sensing, satellite technologies, machine learning, et cetera, to really understand, all of the acres within the portfolio so that we can identify all the specific attributes, be it forestry carbon or solar locations, et cetera. And so that's a skill, and a platform that we see as truly a competitive advantage. Stepping outside of our four walls, this is something we've thought about, but I'd say we have a tremendous amount of work just to really capture the full value on our 10.5 million acres.
Yeah. The other thing that's interesting, so in the solar business, in the solar wind, CCS, you're partnering with companies and developers that are doing things in those areas. Is there anything you would observe around either some of the pace of interest, the intensity of interest, the just how long is the line to get in and see you and do some projects? And then maybe in particular CCS, that's a space that is growing. And so any comments around all that would be great.
Yeah, I think, back when we started the kind of this strategy in 2021, it's interesting. You think you have these powers powers to predict the future, and you don't. I think the business has developed a little differently than what we anticipated, 3 or 4 years ago. Specific solar is much stronger. The amount of solar that's being developed, the cost of installation is a lot lower. However, the headwind on solar is interconnect and permitting. And so we're seeing a lot of activity in solar. We have 100,000 acres that are under, some form of lease. Not all the 100,000 acres will be developed because you're going to see some of those acres fall out because they either can't get an interconnect or they're having problems with the permitting. But we have a very large pipeline of projects that I think are going to come to fruition here over the next couple of years. So, and we see continued investment and continued emphasis on developing solar. For CCS, I think we thought that would develop a little faster than it had. We had done 2 of our CCS agreements, the one with Oxy and the one with Denbury, which is now Exxon, actually before the 45Q was swept up in the IRA and the per ton injection rate was increased. So there was a lot of activity around CCS even before the IRA, stepped in. When the IRA stepped in, it was a big catalyst. So we're seeing a lot more activity around CCS. However, with CCS, again, one of the headwinds has just been getting the permitting in place, getting the entitlements in place, getting through the EPA reviews, the Class 6 well permits, and so we're seeing good progress on our projects. but it's taken a little more time than what we had expected.
Yeah, I guess to piggyback on the back of that, I mean, the CCS business didn't seem that intuitive to me at first, for a forest company. So how are these deals structured? First of all, you said it's been slow, but, what needs to pick it up besides just permitting issues and all? I mean, how many companies are you talking to at this point in time? Is it a half a dozen? Is it dozen? I mean, is there more companies you're talking to than you may say were 12, 18 months ago? And where do you think that goes in the next couple of years?
Mike is probing the CCS backlog here with this question.
Well, let me answer the first, your comment about it's not intuitive for a forest products company, to enter CCS. We've owned many of our acres, particularly in the Gulf South, for a long period of time. And so as part of that, we control the subsurface assets.
Yep.
And as I mentioned earlier, we have an oil and gas team. And it's a relatively small contributor to the total portfolio. But over the last 50 years, every one of the leases that they entered into, they also required that we receive the drilling data, any seismic shoots, any of the geotech data. And so we've been collecting over a long period of time all of this subsurface information. And so when CCS, really started, coming to, fruition, the team basically compiled all this information, put it into offering memorandums, and we went out and started marketing our subsurface. And so we're in conversations with, a lot of different companies. They love how we come to market because we basically compress the amount of time that it takes them to assess an opportunity, because we have all of the historical seismic information, and we have geotech reservoir engineers, geologists, et cetera, that can work directly with these teams. So I think, we came out of the gate pretty fast on our CCS offerings. What we have focused on, though, is because of the complexity of the development and the time it takes to develop these projects, we've really focused on identifying kind of those really first-tier type operators that can navigate that have the financial wherewithal, the understanding, the sophistication to really get one of these projects through all the requirements. So that's been a big focus of ours. But there are some acres, that are outside of what I call our target zones. And so we've entered into just recently that agreement with Lapis. Two of the areas that we're in discussions with them are kind of within that 500,000 acres that we identified as potential development areas. But three of the other locations are kind of outside, not areas that we would have expected to come to market in the near term. So they're developing that. The bioenergy, carbon capture and storage, those are good solutions for those areas where it's remote. It's not proximic to pipeline infrastructure or heavy industry, such as steel or fertilizer or ammonia. And so those are going to be kind of different profiles from the standpoint of a development standpoint. But, the market's very active. The capital is forming, the incentives, the tax incentives are there. We're definitely busy, and the team is keeping very busy.
Hey, Russell, last one from me. Going back to the forest carbon business, I just, it's a little bit like Maynard's question of how does a contract work, but I'm going to ask more like, how do you decide where good locations are? What's this good spot? What's a customer going to want? I assume you have different regions of the country with different kinds of wood. There's different ambient conditions. There's different meteorological conditions. Like, what do you guys look at to say, this is the package that we think is going to make a really good project, or this is a package over here might be a terrible project and we need to go harvest it? Like, how are you balancing all that? And what are the 3 or 4 things that are critical in kind of project development for you?
Yeah, I'd say the 3 or 4 things. One, again, we use a lot of our kind of remote sensing tools and our evaluation tools to screen our properties. And so we can identify which areas are suitable for forest carbon development. We look at, what is the market? Is it a well-structured market, or is it a high demand market? And so we have to make sure that, some markets are stronger than others. Some markets are emerging. We don't want to create a situation or put a forest carbon project into a market where you have a tremendous amount of demand, because then what happens is your customers will go harvest more aggressively or acquire timber in other areas, and that causes what we call leakage. So the goal is for the whole forest to actually benefit from the growth of timber. We just don't want to restrict a part of the forest and then, other parts of the forest are harvested. So on a whole, that forest really is neutral. And so we really look to where the market will support a carbon project, but then also support ongoing timber operations. We also look at age class. That's an important factor in determining how that forest will perform over time and how much carbon can be sequestered over time. So those are kind of two areas that we definitely focus on. We look also regionally. There's some regions where timber prices are much stronger. We started up in the Northeast. Those timber values are not as strong as, say, the South, but the West is much stronger than, say, the South. So our first focus was up in Northeast, where, again, the timber markets, because of where carbon credits were trading, the economics made sense to make that trade-off between harvesting timber, leaving it on the stump longer, changing silviculture to grow more fiber. In the South, we've been very selective on which markets we're developing for potential forest carbon projects. And in the West, I think that will take some time. You'd have to see carbon prices, increase, I think, pretty significantly for it to make sense to do the trade-off from growing that timber versus or harvesting the timber versus growing for a carbon outcome.
Are you finding, Russell, we're going to have to let you go because you've been very generous with your time. You got to cut us off or we'll just keep going. But I think the punchline, we find this also interesting, and it seems so useful and cost effective, and you guys leaning into it is really helping. Do you think nature-based solutions are really gaining in credibility? And it's what do you sense from the sort of policy community or the those most focused on solutions? Is this getting the boost we hope it's getting?
I think it is, and I think you got to kind of pull away. You kind of pull back and really look at what is the problem set that we're trying to address. And when you look at the net zero targets, if you go to the UN IPCC, they run a lot of scenarios on how to limit warming to 1.5 C over the next, say, 50 years. There's no scenario where nature-based solutions don't play a meaningful part. I just don't think the technology solutions, they're going to take time to scale. I think they're going to be important over time, but they're going to take time to scale, and they're very capital intensive, and they require a lot of permitting. Nature-based solutions are here. They're ready today. We know how to grow trees. We know how to grow trees to store carbon. It's a very efficient way. Trees have been growing for 100 million years. And so we know the technology. We know how to do it. We know how to scale it. And so I do think that in this near term, you have to look to nature-based solutions to help you bridge to when the technologies really come to scale and can have a meaningful impact on carbon reductions. I just don't see another way around it. And I do think the market is starting to recognize that. I think there are a number of companies, particularly tech companies, that are realizing that they have to embrace the nature-based solutions if they're going to have a meaningful impact on meeting their net zero targets. So my overall view is I'm very, very bullish on kind of the overall demand profile for nature-based solutions, forestry carbon, solar. And then when you move kind of towards the tech side around CCS, bioenergy carbon capture, fiber to fuel, SAF, et cetera, I think we're going to see a tremendous amount of innovation, a lot of capital looking for solutions. But in the interim, I think you're going to see a lot of focus on ensuring that we capture the full benefit of our forests, our other agricultural solutions.
And just one last question. Do you think we could see a technological innovation within nature-based solutions, whether we more and more in terms of how we approach the bioengineering, if you will? Do you see those types of things? I assume you guys are working on those types of things.
We are. I think, if you call it alternative fuels, one of the things that's really interesting, Maynard, is you hear a lot of different technologies, be it nuclear, et cetera. But when you're just taking a replacement fuel, so for instance, pellets really emerged in the marketplace over the last 15, 20 years, primarily going into Europe to replace coal, burning coal for energy production. I think you're going to see much more sophisticated processes that produce better products to go into drop-in fuels, coal replacement, et cetera. And when you look at the availability of fiber, that seems like a very natural feedstock to satisfy those. I think the food for fuel, the ethanol, corn ethanol, et cetera, those are a bit problematic. But there's plenty of fiber for us to start really cracking the nut on how do we produce, drop-in fuels, SAF, et cetera, energy replacements out of wood fiber. So I think you're going to see a lot of activity in that area, and that will increase significant demand for our products and for our fiber.
Awesome. Well, Russell, we can't thank you enough. We just cold called you guys and got into this conversation and started getting to know you, and you've been so responsive and thoughtful, and we're just so pleased that you would spend time educating us today.
Well, I really appreciate the opportunity, and we look forward to doing it again with you guys.
Well, fantastic. Thanks, everybody.